All right, let's dive right into this explainer. Today, we're doing a full teardown of a brand new draft regulatory document, specifically the Scheme Information Document for the Motilal Oswal BSE Clean Environment Index Fund. Now, if you follow the green energy space, you already know massive capital is flowing that way. But how do you actually invest in it through a structured vehicle? Well, that's exactly what this document reveals, and we're going to unpack the whole shebang together. We've got four main things to hit today: what the fund actually is, how its passive mechanics work, the costs and minimums to get in, and finally, a very sobering look at the risks. Okay, part one. What is the fund? Let's explore that core investment objective. The absolute foundational rule to understand right out of the gate is that this is a purely passive vehicle. It's not trying to outsmart the market. It's simply designed to replicate, or effectively become, this specific clean environment index, subject to a few operational realities we'll get into. And you can really see where the money goes here. The regulatory guidelines mandate that a massive 95 to 100% of the fund's assets go directly into the underlying index constituents. That tiny remaining sliver, up to 5%, is just cash kept on hand for day-to-day liquidity. So it's an almost pure, undiluted play on the index. But what does clean environment actually mean to this fund? Well, it strictly targets companies handling clean energy, water management, waste management, and recycling. This isn't some fluffy ESG fund that just screens out the bad guys. No, it's funding the companies doing the literal, and sometimes quite dirty, industrial work of cleaning up the planet. Moving on to part two, how passive investing works. Let's peek into the engine room. I always like to think of this type of fund as a mirror. While an active manager is out there sweating, picking winning stocks, or trying to dodge a market crash, this passive fund just reflects the benchmark. If the sector booms, it captures that growth. If it crashes, it takes the exact same hit, completely on autopilot. But mirrors aren't always perfect, right? And that brings us to tracking error. It's a bit of financial jargon, but it basically measures how closely the fund actually manages to copy the index. More specifically, it's the standard deviation of the difference between the daily returns of the index and the NAV of the scheme. In a perfect, frictionless world, this number is 0. In reality, there's always a slight gap. So where does that gap, that tracking error, actually come from? Well, real-world friction. The document outlines a few culprits: the drag from the mutual fund's own fees, cash sitting around for redemptions, sudden halts in exchange trading, and even the simple math that a fund can't always buy fractional shares. Those tiny bumps create a structural disconnect between the theoretical return and your actual return. All right, part three, costs and investment minimums. Let's talk about the literal price of admission. First up is the total expense ratio, or TER. This represents the absolute maximum base operating cost you're going to pay annually for this passive management. According to the draft, it's capped at 0.90% of daily net assets. That covers everything: investment management fees, audits, marketing. Because it's passive, you naturally expect lower fees than a heavily researched active fund, but it's super important to know exactly where that regulatory ceiling sits. Now, what if you jump in and suddenly change your mind? Well, there's an exit load structure built specifically to discourage short-term speculative trading. If you bail and redeem your units within the first 15 days, you're hit with a 1% exit load charge. But hold it past those first 15 days, and the charge is totally nil. So this clearly tells us the fund is structured for actual long-term investors, not day traders. As for capital, what does it take to get started? If you're dropping a lump sum, the barrier to entry is just 500 rupees. That's what, the cost of a couple of coffees? It is an incredibly low hurdle if you want to take a targeted position without locking up massive amounts of cash up front. And if you're an SIP person, you prefer averaging out your costs over time, the minimums are incredibly flexible. You can literally invest just 100 rupees on a daily basis. More of a monthly routine person? Just 500 rupees. This setup makes it really easy to slowly build a position in a volatile sector entirely at your own pace. Which brings us to the most crucial part of the explainer. Part 4, understanding the risks. It's time for a reality check. Look, it is so easy to get caught up in the positive, feel-good narrative of a sustainable future. But as a savvy learner, you've got to ask, what are the inherent objective risks here? What is the regulator actually warning us about? Well, here's your visual punch straight from the document. The mandatory riskometer firmly, and I mean firmly, categorizes this scheme as very high risk. Look at that dial, pushed all the way into the red. This is absolutely not a safe, predictable return. It is a highly volatile equity product. And that very high risk rating, it stems directly from concentration risk. Because this fund only holds clean environment stocks, it completely lacks the broader diversification you'd get in a total market fund. That makes it incredibly vulnerable to sector-specific shocks. We're talking sudden regulatory developments, shifts in government policies, unpredictable tech adoption rates, or massive capital expenditure cycles. Like, if the government suddenly pivots on solar subsidies, this entire fund is going to feel that impact all at once. We also have to factor in the invisible structural risks of passive funds. It is absolutely vital to grasp the difference between the tracking error we talked about earlier and tracking difference. Tracking error looks at daily volatility, but tracking difference, that's the annualized difference in actual returns over the long haul, 1, 3, 5, or 10 years. A tiny daily tracking error can snowball into a noticeable tracking difference over a decade, meaning your real-world returns might actually lag the theoretical index numbers you see online. Actually, this single quote from the risk factors lays bare the unvarnished reality of index investing. It says, the fund would not select securities without adopting any defensive measures. Meaning, if the sector crashes, the fund manager is legally bound to go down with the ship. You have zero buffer. You are 100% exposed to the raw movements of the index. So, as we wrap up this explainer, you're left with a pretty vital question. Does a highly concentrated, purely passive approach to environmental themes, with all its very high-risk baggage, truly align with your personal investment horizon and your appetite for volatility? You've got the mechanics, the costs, and the real vulnerabilities straight from the source document. Now it's a giant puzzle, and it's up to you to decide if this piece actually fits your financial picture. Thanks for exploring this with me today, and as always, keep asking the hard questions,